So we'll kick off. Today what we're going to look at is delta. We're going to have a really deep dive into delta and how we interpret it when we read the traded volume. Delta is one of those things where I think the information that's out there on the web is quite high level. And today we're really going to go deep. And one of the things which jumps out immediately is delta is such a generic term. It means difference. In the context of order flow, it's taken to mean the difference between ask volume and bid volume. We subtract the bid from the ask in the context of market orders, so it gives a sense of aggression. But even then, we can have horizontal delta, we can have diagonal delta, and it amuses me that you go on the Sierra Chart website, and you get on the Sierra Chart website, and what you get is them lecturing you saying delta means difference. We will refer to this as ask volume minus bid volume. So let's not throw it around too glibly without first understanding how it's derived. What I'm going to do today is get into both how it's derived, but then also how we can apply these different measurements of it. Something we have to do every time is just get through the disclaimers. This is an educational presentation. We're not making any trading advice. We're not going to make recommendations. All the examples are hypothetical. Use your own judgment on what you're hearing. I hope it makes sense to you. Your mileage may vary. Okay, and here's the agenda. We're going to split this into two halves. Firstly, we're going to be really clear on the definitions and the terminology, and we'll use the metrics of delta for each bar with a bit of an overview of how to use them. And we'll look at kind of some intra-bar delta metrics and also look at the application of delta across bars. Then we're going to get heavy, and we might have to go through this a few times depending on the Q&A, or we'll revisit it at the end. But I'm going to kind of break apart some of the assumptions and some of the things that you think you may know, and we'll then look at how we can really look at delta using the mindset of really an algorithmic trader, and how you can really start to make heavy use of some of these metrics and get some advantage. And based on what I've seen out there, this is not stuff that you're going to see on the web or Investopedia or even on webinars from order flow practitioners. So you're hearing it here first. So without further ado, let's dive in. Delta, so it's the difference between ask volume and bid volume. And the way I would contend that most people see this is in their trading platform, they'll have a line for delta sitting below the candlesticks. This is summary data, it's numbers, bars, calculated values in Sierra Chart. And what you're seeing is bar delta. So for this particular bar here, if we add up all of the ask volumes on the right hand side of the candle, and we subtract all the bid volumes here, that gives us the net of what quantity lifted the offer less how much hit the bid, and that's 314 contracts net for this candle. That's delta. Now, lots of people just present this as a row of numbers underneath the chart. Maybe they present it as a histogram, but during the formation of this candle, let's remember that the candle has bounced up and down, and these volumes have increased on each side. But of course, the net of the delta during this process has changed, and a candlestick is the logical representation to show this change. So in this candle, while it was forming, the highest value of delta was 108, positive. The lowest value of delta was negative 53. The delta when the candle closed, I'm using a range bar here, so we are always going to make a new candlestick based upon getting to the extreme of the range. But when the bar closed, the closing delta was 46. So if we visualize this candlestick, I mean, when we started out with our technical analysis and reading candlestick charts, we knew that a candle that closes near its extreme is strong. So what we can tell here, and naturally it's a range chart, so we are closing at the extreme, the delta closed near its negative extreme. It's going to be the case on this range chart that pretty much all of the deltas will close near their extreme because of the way in which we're constructing these bars. But it helps to embed the concept of the strength of delta for the bar by considering where has delta closed versus its maximum and minimum during bar formation. If we've had a maximum of plus 100 and a minimum of minus 100 and we close with 10 delta, you know the delta's somewhere in the middle. And that's a really different situation compared to the delta closing at 99 out of a maximum of 100. So you get a sense of where we've closed within the range of net aggression, and you can get a sense for how likely is this to continue. So those are the basics of delta and the strength of delta by comparing it to the maximum and the minimum. People also look at cumulative delta. Very simply, this is let's take delta from the start of the session and let's keep adding it bar to bar. So at the starting point on this candle, the cumulative delta was 780 since the start of whenever we started, probably the overnight session, looking at the timestamps. In the next bar, the bar delta was 362. 362 plus 780 is 1142. 1142 plus 314, 1456. The next one was negative, negative 46. That's how we get to 1410. You're seeing the same pattern, but you're looking at the aggregate and the slope rather than just bar to bar changes. And depending upon your comfort factor of how you visualize this, I like to run cumulative delta as a line chart underneath the main price. You can get a sense of how is the change in each bar's delta affecting us on the day, so you get to see a slope of the overall buying and selling pressure as we go through the day. So those are the basics, and I'm going to imagine they're pretty comfortable for most people. Now, before we move on, I want to clear up some terminology. You have some order flow vendors that refer to COT, commitment of traders, and with Jeff using MZPAC, I know he's referred to COT as shorthand a few times, so I just want to be clear on what it is and how I'm going to refer to this concept. So MZPAC refer to COT as commitment of traders, and there are two of them, COT high and COT low. So they explain this as cumulative bid-ask delta, a bit confusing, from the moment when price makes a new high or repeats the previous one. It helps to see buy-sell balance after a new price level has been reached. Not the clearest explanation in the world. So what they're actually saying is if we have a candle, like we see it here, and we make a high, but we start to come down from the high, the COT value is the delta that's been occurring as we come off the high. So it's not the delta within the candle, but if we go up and we come down, so here's minus 23, on the way down, the new volume that occurred since this price point was net minus 23 contracts. Gomi, who produces a footprint and some order flow stuff for Sierra Chart and also NinjaTrader, they explain it in a similar way, a little bit clearer. High COT is the delta since last time price touched the high of the bar. Oh, it's usually negative. How about that? It's usually negative. Maybe you can trade off that, I don't know. So slightly clearer explanation. He's actually saying the same thing to MZPAC. Noft, Kai, and there's long rambling stories about in the battle of price, it's the volume that drives the outcome. He mixes it up a bit and confuses things. The COT, or commitment of trader, is where the most volume is taking place. So in Noft's view of the world and their order flow education, the highest volume level within the candlestick is the commitment of trader, because that's where traders are committed. Well, most people would refer to that as a point of control with POC, or the highest volume node. So even amongst three order flow add-in vendors, we've got a few differences in terminology. Diving deeper into the Gomi user guide, they'll also make a note, if you're on Sierra Chart, if you're going to use COT on Sierra Chart, you must set up pullback within the chart settings. So historical pullback data here. And pullback is probably the best way to explain this concept. As we pull back from the high or we pull back from the low, let's start counting the delta. It's like if you hit reset in the DOM. So the reset button is occurring automatically because we're trading off the extreme of the candle. So for a couple of reasons, I really dislike this phrase commitment of traders and the abbreviation COT. Main reason is this is what COT is. COT is a report issued by the CFTC each week that tells us open interest in futures contracts, and it's quite a useful long-term measure. Now, I find it a bit, probably a bit offensive more than anything else, that we've got order flow vendors taking an existing establishment bit of terminology and applying it to some arbitrary calculation within a candlestick. So in my world, any reference to COT relates to this trading report. And the way in which I consider this concept is pullback. So we covered this, I think, a few clinics ago on why price moves, but let's really go through the concept of the pullback within the candlestick, and whether we're looking at volume or the delta, this will embed the mechanism of what's going on here, and we should be able to start to have common understanding and common language. So let's start out by considering this 30-minute candlestick. Yep. As you know, I mandate that any candlestick period is wrong, whether it's 30 minutes, 5 minutes, 4-tick reversal, 10 range, whatever. So we've got a 30-minute candlestick, and the algorithm to paint a new candlestick is 30 minutes goes by, we'll paint a new one. 30 minutes goes by, we'll paint a new one. Inside this 30-minute candlestick, let's imagine this starts at 9 AM, we could have 5-minute candles, we'd have 6 of them. So here's 9 o'clock, here's 9:05, here's 9:10, here's 9:15. Now, the candle opened here at 9 o'clock. The first 5-minute candle is going to reflect what's going on during the first 5 minutes. If you had a 30-minute chart open, 5-minute chart open, these would paint the same way. And that's why the volume at the bottom, you can see 1118, 1118, 764, 764, it's the same during this opening period. 5 minutes passes, we create the second candle. Now what happens, we trade it up to the high, and you can see 276 by 775 at the top, the same thing. So in the second 5 minutes, we opened, we went up, we came down. We then chopped around a bit, the third 5 minutes. Now look at the fourth 5-minute period. We opened and we went back up to a price level where we traded at 9:10. So we can see at the second price level from the top in this 30-minute candlestick, our volume print is 361 by 591. This has occurred by us going up here, trading, coming down, coming back up. Now, in this second 5-minute period, our volume was 361 by 548. The difference between the 548 and the 591 is here. It's these 43 contracts that lifted the offer 20 minutes in. So a candle is always an aggregation of smaller arbitrary timeframes inside it, and we can see that within the volume. So if you can conceive that this volume has aggregated up over many different time slices or fractals, then you can also start to conceive that as we've traded from the high, we can start to track the volume that has occurred on the way back down. And that volume here is the pullback. So here's our original 30-minute candle. Here's the volume that has traded on the way back down. And that's the simple concept of pullback. Some trading platforms will actually show you the pullback candle, and you can show this as a footprint. I use this in Sierra Chart, but we can also track the same metrics on this pullback volume as we can on the main volume. So when people are talking about COT, forget COT, let's call this pullback volume and pullback delta, we're referring to the volume that's occurred since we've come off the high or the low in whatever time period. So that is really quite an interesting metric to start to track, because it's showing us what I like to call the auction within the auction. Whatever time frame we're tracking here, as we come away from the extremes, we're auctioning back down. This is telling us what's happening in this auction. And we could take this to an extreme and go, well, what about when we come off the bottom here and here and here? And it could go on forever. But think of this in terms of the auction within the auction, and it should start to make sense. It's what has been the trading since our recent extreme high or extreme low. And if you are really in love with hitting the reset button in your dome, think of it as a reset button that's being automatically hit on your behalf. So how can we work with this pullback delta? Well, these two vendors who are misusing the COT phrase, they can't agree on how to use it. So MZPAC is saying, if we're in nut trends, then actually what we want to see is positive pullback delta. In other words, as we've come off the low, we want to see aggression. We want to see positive delta. We want to see buying pressure coming off the low as we come off the low. Yeah, that makes sense. Let's have market orders driving things up. Gomi is actually saying the other thing. He's saying at the low, it's really good to see negative pullback delta, because it shows that the aggressive selling isn't going anywhere. Well, isn't that just the exact opposite of what MZPAC's been saying? Now, who's right? Actually, both of them. There are different ways to read this. For the moment, don't worry about the fact people have got different views on how to trade this. I'm going to go through an example at the end that will give you another take, and hopefully with a real foundation, first principles understanding of these metrics and where they're coming from, you can then play it both ways, but you'll have a real ground up understanding of where these numbers are coming from and what they mean. But it amuses me that the same metric, the same calculation is being presented by two different vendors of the same thing with different recommendations or guidance on how to trade it. So take everything you read with a pinch of salt. That was a little bit heavy. We'll go back into something a little bit simpler before we get really heavy. Let's go back to the idea of bar delta. So, we're comfortable with the fact this has got 598, this has got 362, this has got 314. You have probably come across the phrase delta divergence, and divergence of any indicator versus price is an important concept. If we are making new highs and something else isn't, okay, let's look into this. So what's the situation we've got going on here? Price is trading upwards, upwards, upwards. Okay, this candlestick has come down, but we still made a new high. What's happening to delta? Well, we've got 598, 362, 314. So we can see we've got a sequential decline in the positive deltas. It's getting lower, lower, lower. This one, the delta went negative. Let's explain this in English language. Price is making new highs, but the amount of aggressive buying as we make new highs is getting lower. Now, you talk this through in English, your understanding gets really embedded, and it's pretty obvious what to do. It tells us that we are running out of aggressive buying as price is going up. So maybe price is getting too high. Now, different vendors and different educators will have many different ways of explaining delta divergence. Who's right? Nobody. And so understand how you could possibly classify it, and you decide the way in which you want to see it. So we could have a sequential decline of the deltas like we're seeing here. This is lower than this is lower than this is lower than this. This one's negative. It's changed from positive to negative. The polarity has changed. So, here are some filters. Do we need the polarity to change? Do we want to see a sequence of declining values? Do we want price to turn around? Do we actually want this price action, God, I hate that phrase, to confirm what we're seeing in the volume? That seems a bit upside down to me because volume moves price, but there we go. Maybe we want a bit of forgiveness factor. In some vendors, one of whom I'm very familiar with, have coded their indicators up. So we could say, well, what if we're within 1 tick of the previous high? Would we count that as a delta divergence? There's enough times when we see things get to within 1 tick of a significant level and then turn around. Do we want to consider the bar delta or maybe the cumulative delta? Now, the cumulative delta is just expressing this shape of the bar delta in a different way, but we could use the cumulative delta in the shape of that curve versus price in order to make our assessment of whether delta is diverging. And market delta, rest in peace, they actually have the concept the other way around as well, price divergence versus delta. So delta is higher, but price is lower. So they let you look at divergences both ways around. I'm not certain of the value of that, but there is no clear definition for what is delta divergence. So I urge you to understand all of these potential filters and ways of calculating it, see what makes sense to you and see what resonates. But let's actually look at the reality of delta divergence. Think back to the chart a couple of screens ago on the pullback volume and how candlesticks are composed of multiple candlesticks inside them. So what we've got here is a 30-minute chart, wrong period, of course. We are showing a kind of delta divergence. Okay, we're 1 tick off the high. The indicator I right would let you see that if you wanted to. But what is clear is we traded higher, delta has got weaker, here it's got significantly weaker, and we've traded down. But let's imagine we crunched all of these candlesticks together. Let's look at the volume that we would get. At the top, our print on the offers would be 13 and nothing traded here. One level below, we'd have 177 plus 5, so 182. 2 price levels down, 134 plus 208, 342, etc., etc. So if we looked at this on a 1-hour candlestick or the full session, then what we would actually be seeing at the top of this candle is reducing aggressive volume as price goes up. Now, if you cast your mind back to our clinic on aggression, then what we're seeing is in aggregate, we have got less aggressive volume at higher prices, which we call exhaustion. So delta divergence is actually horizontal exhaustion. And the problem is people are brought up on have your charts horizontally, and then this amazing concept of delta divergence comes along. Okay, we've got reduced aggressive buying, maybe, depending on how we arbitrarily cut the time slices, but in actual fact, crunch all the volume together, you see the same thing as exhaustion, and you save a whole heap of screen real estate. So the key thing is think vertically. Peter Davis has said, price doesn't move horizontally. It's probably, oh, price don't move horizontally. I can't do his accent. You get the idea. Anything horizontal is an optical illusion. So delta divergence and this kind of thing, it's not a bad early warning if the arbitrary divisions you got horizontally enable you to see it, but you can get a much cleaner read if you read the volume vertically, even do some mental arithmetic if you need to. At first glance, 134 plus 208, well, we know that's going to be more than 177 plus 5, even without knowing it exactly. So start to read things vertically, and you can save a whole heap of time in terms of how you are assessing stuff. So there's the first little bit of upset. These common things relating to delta are not so important once you actually understand how to read volume vertically. Here's another upset on bar delta. It's late, always. So people kind of think, if I'm going to wait for the delta divergence, so I'll wait for delta to turn negative and then I'll trade. The problem is bar delta is reading the whole bar. This is what? It's a 5-minute chart, which I've got here. So I'm using a 5-minute chart to avoid any distortion of when each new bar forms based on price. If this was range, we'd always be closing at the extreme. If it was reversal, we'd have more of a sense of the auction, like a bird in the sky off the end of each bar. 5 minutes is totally wrong, so I'm not having any price wizardry influencing how this forms. So what we've got going on over this 5 minute period, look, I've got a delta divergence, great trade, let's take it. Well, when would you have taken it? When the candle closed, you enter here, you are what, 8-10 ticks away from the high. Still probably not a bad trade in terms of what's going on, but you're late. Now, let's actually think what happened inside the formation of this candlestick. This was a down candle. This opened, it traded up, and then it came down. And it will have wiggled around during that time in different ways. But over this 5 minute period, opened, went up, came down, closed. That was the story of this particular rotation. So we have got a snapshot of the delta at each price level. So you can see 443 minus 0 is 443, 189 minus 189 is even, 1321 minus 169 is 152, etc. We've got positive delta at the top, negative values here. So if you were watching this in real time, there would have been some point where the bar delta hit its maximum of 613, and that 613 has come from, it isn't actually these positive numbers, it's whatever was dynamically occurring during the candle formation. But because we closed at 1539 negative versus a maximum low value of 1543 negative, there was some point where we flipped from positive delta to negative delta. We had an inflection at some point, or even multiple points, during the formation of this candle. And the way we can understand it is think about the made-up phrase, internal cumulative delta of this candlestick, by thinking about what happened at each price level. So if we, because this was a down candle, we'll start our cumulative sum from the top. We'd do the opposite if we were working up on an up candle. So to read the delta position cumulatively through the lifetime of this candle, we'll take the 443 at the very top price level. Then that's our opening level. Nothing changed the next level down, so we remain at 443. We had positive 152 at the next level down. So we printed here at 595, but we ended up with negative 191 trading at that level. Then we had negative 947 at this price level. That's the point where our delta in the candle flipped from positive to negative 543. So we can think of this as the inflection point within the candle where we changed from net aggressive buying to net aggressive selling. So if you were watching in real time, this would have been more dynamic, but you can see how here was the point where the dynamic changed. Now, the pullback would have been a method to go and see that. Or maybe you would have hit reset in your dome here, or maybe here, or here. So this starts to get really interesting when you understand the dynamic of bar delta and you release yourself from reading the closing total, or what is the aggregate sum of the delta, and you open your mind to the fact that this is dynamic. I want to see the change vertically as this is forming. And that becomes a much stronger way to trade using the information that we're being presented with by delta. Now, in order to explain this internal cumulative delta, what I've been looking at is the delta at each price level. I refer to this as delta at price. Let's quickly look at the mechanic, and we'll use the same candlestick in order to explain this. We'll use this inflection point price where we changed from net positive to net negative. So 54 even has traded both as a price where you could buy and as a price where you could sell. So the inside market has been 53 3/4, 54. 54 was the offer, so you could lift the offer at 54. It's also traded as 54, 54 1/4, and you can hit the bid at 54. So the delta at price, the horizontal delta, is how much aggressive buying happened at 54, 1,120 contracts, less how much aggressive selling happened at 54, 2,067 contracts. 1,120 minus 2,067 is negative 947. So this negative 947 is telling us the outcome of the, let's think of it as the market's preference for this price. Was it a price which was more popular to be lifted or to be hit? So we can now really start to understand the story of every price level during the auction by considering the delta at this price level. So that's the mechanic for how we get to these numbers, but how do we interpret it? So we'll look at the same candlestick, and I've put together a little table here. So in this candle, we are trading below various levels of delta. This candle's closed at its low. Now, where we are trading relative to positive delta or negative delta tells us who won, the market orders or the limit orders. If we have got positive delta, like we do here at the top of the candle, and we're trading below it, what that means is all of the market orders, because this was more aggressive buying than selling, it's positive delta, 443 versus 0, 1321 versus 169, all these aggressive buyers ultimately lost because we're trading below it. So the aggressors are on the wrong side. The limit orders, the passive sellers, they won. Each of these price levels, the inside market, is a fight. So the relationship of price tells us, by considering the delta, did the aggressors win or did they lose? So if we are trading below positive delta, then the aggressors got it wrong. Likewise, if we're trading above negative delta, let's imagine we're trading here, all the aggressive sellers hitting the bid, they got it wrong. So with this in mind, we can start to understand who is in control at any moment within the auction. Okay, David's asked if I can repeat that one more time. Sure. So let's say we are trading at 54 even. We've got 3 price levels here with positive delta. Okay, let's ignore this one, but here is it positive, is it negative? It's neutral. The price levels with positive delta mean that at these price levels, there was more aggressive buying than selling. So it was aggressive market orders that dominated the trading at these price levels. If we, for whatever reason, are trading below the positive delta, every market order placer, every person who has placed a market order to buy here, and we're trading below it, they're wrong. They're trapped, they're offside, they got it wrong. Okay, they may have been closing a position. You know, we don't know that, but you get the principle. If you have lifted the offer and we're trading below it, you're wrong. So the aggressive traders got it wrong. The passive traders with their limit orders are in control. They've pushed price back down. If we are trading above negative delta, the aggressive sellers, because who dominated each price level, they're wrong. If we're above negative delta, aggressive sellers are wrong. If we're below positive delta, aggressive buyers are wrong. This is something to look at and really embed, and it will take a few times, but ultimately it becomes second nature, and you can see if I'm below positive, I know the aggressors are wrong. We can also use this the other way round. If we are above positive delta, then the limit order's lost. So let's imagine we're trading up here. Yeah, the mechanic that's been going on is aggressive buying. That aggressive buying is being matched by passive sellers. If we continue up, Those passive sellers, whoever they are wrong because we're above where we are. If we are below negative delta, it means the aggressors are in control. So everybody who is happy to passively buy from aggressive sellers, they're wrong. So the way I'm most comfortable remembering this, because I care actually most about the power of the passive people, I'll explain that why in a minute, I have it embedded that if I'm below positive delta, the aggressors have got it wrong. When the aggressors, the market orders, have got this wrong, the jargon for this is absorption. The passive orders have absorbed all of the aggressive trading. All of this aggressive buying has been absorbed by passive selling. So limit orders have absorbed the market orders. There was more sell-side liquidity than aggressive buyers could consume. If the market orders are winning, we've got aggression in control, it's momentum. And there's a fundamental difference here to what's important on whether you're swing trading or scalping. I do scalp, but my comfort zone is actually looking for a few good intraday swings based on the structure of the market. Now, if you read Mind Over Markets, Dalton, he has the idea of the short-term traders and the other time frame traders. So, other time frame trader is American Airlines, to go back to the clinic on why price moves, who need, I don't know, 100, 200, 5,000 CL contracts to deal with 1,777 each month, whatever the big number is. If American Airlines are going to fix their price for aviation fuel over the next month by hedging using CL, they can't do it in one trading operation. They can't go and lift 5,000 lots of CL in one go, because they will strip out a gazillion price levels in the market, shoot themselves in the foot and pay more than they want to. So commercial users, other time frame traders, long-term people, if you are trading volume, you effectively trade your volume using limit orders by working your orders into the market. There's an order flow educator out there who I associate with, who he used to run the Far Eastern desk for JP Morgan. And he said, actually, in those days, they would work out their trading plan. The computer would work the order into the market over 7 minutes. So the institutions, but if you're trading volume, there are algorithms to effectively get your volume into the market using limit orders and market orders and whatever. But I contend that long-term money and big size can only build up its position using limit orders, working their orders into the market. So for swing trading, I'm very interested to see that the limit orders have got the control, because it tells me where the people that really care and can really move price around have stepped in. For scalping, I want to see that short-term people are in control, and it's the job of short-term traders to push the market as far as it can go until it goes no further, because the long-term people step in. And that's the auction process. It's why liquidity providers, locals, scalpers exist. It's their job to push as far as they can in one direction on any time frame until other money overwhelms them, then you push back the other way, and that's why we bounce around. So understand the difference between seeing who is in control based upon reading the delta at price and where we are trading relative to the delta at price, and you can start to read the whole story of what's going on. So with this idea of reading the story, let's take this a little bit further. So think vertically. What I've got here is, I have no idea what time frame this is. Let's assume this is a 30-minute candle. Could be the day, who knows? This isn't a volume profile, this is a delta profile. So I am illustrating the delta, 227 minus 0, 663 minus 545 is positive 118, 989 minus 1007 is negative 18. We've got the delta for every price level within this bar. This bar happens to open. It closed higher than it opened, so did it, go up a bit, wiggle back down, go up? Who knows? But we can see that during this auction, there was a level that was too low, there was a level that was too high, and we closed somewhere in the middle. So a few things start to jump out. The highest positive delta, 856 contracts, is here. And I've highlighted this in the platform. Now it's positive delta, but I'm highlighting it red because it's interesting to me to be below positive delta. This is telling me where longer term volume has stepped in, and this is too high if we're below it. Look where the largest negative delta is, which I'm highlighting blue. Now, on your on your TA chart, there will have been stuff going on like this, because this is the range. These big delta values ultimately are where this was established as too high, this was established as too low. On your horizontal chart that wastes all your screen real estate, you will have had this. But you pull up a long-term chart and you start to look at these big areas of delta. Now, this platform only lets me do the maximum minimum, which is why it's interesting to have a profile as well. You start to see the story of where was the range. And you can, I will trade 30-minute candle purely based on where is the maximum, where's the minimum delta. Because if I'm up here, in quotation marks, resistance, what a stupid word, yeah? This is actually supply, because passive sellers are very happy to keep selling at this level. Then I can be short here and I can be long here. And for the 30 minutes where we're bouncing around through here, maybe I've got a upward bias. And something I was taught when I was in a prop firm was when you get the congestion in the chop, once the range is established, now it's going to take a while on the rubbish horizontal chart to establish the range, but the delta tells me immediately where the range is. Let's say I'm long. Let's say I'm long with one lot here. As we bounce around, go long with another two here, take one off here. Put that other one back on here. You can have 3, 4, 5, 6 bites of the cherry, building up some P&L, supporting your longer term swing move. But we don't need to waste real estate looking at horizontal charts. The delta at price gives us everything we need to know within the auction. For me, I find it comfortable doing this on a 30-minute candlestick because that's no different to the reading traded volume in the DOM, and I actually have my DOM on the 30-minute candlestick in my platform. But you get the idea. Pull up a session footprint, pull up a 30-minute footprint, look for the big and small deltas, and now you can visualize your horizontal charts in a much more efficient way. And it's also telling us who's in control. As we saw in the previous chart, we consider where price is compared to delta. Here, no one's in control. We're in the middle of the range. Yeah. So what we know is that this is quite well balanced because this was too high as people with volume think about it. This was too low, which is why I color the minimum maximum this way to make it easy to read. But what about when it doesn't happen that way? So what I've got here are 3 more candlesticks. It's 30-minute charts, you can see, and I'm middle of the day. Okay, it's lunchtime, stupid time of day to be trading, but we've got 3 different conditions. Here, we have got something that was too low at the bottom. Okay, that's good. Look at all this negative delta. So we had passive buying, dominating aggressive selling near the bottom. I like that. It means we're in good shape. At the top, look at all this positive delta. Yeah, it was too high. But look where we closed. So we can start to read a few things here. Anything in quotes here is just terminology which I'm making up as shorthand for the purposes of this. We know we had a range here because this was too low, this was too high. Look how much volume traded through here. There's a real push to get through. Now, anybody who aggressively sold near here, they were clearly wrong because we're trading above it. There was certainly a fight. The limit orders were really trying to push back the buying, but ultimately the buying won. So let's think of it as the one person who sold 1,139 contracts here, wasn't one person, but you get the idea, they're now wrong. We've closed above where a passive seller was happy to sell, so we can read the story. Now, the aggressive sellers here got it wrong. The aggressive buyers here have overwhelmed the passive seller. That passive seller's not too happy. Oh, look, we start to get some aggression on the way up. But something important to understand is this relationship is kind of the right way round. We have got largest negative delta at the bottom, largest positive delta at the top. So I like to see ranges formed by passive traders being in control the right way round. I want to see positive delta above negative delta. This is logical for me. This means that the passive traders, the limit orders on both sides, are in control and we've got a range. Okay, in this case, the range is broken, but you get the idea. Blue should be underneath red. But look at this one. Blue is above red. So what does this mean? This means the aggressive traders are in control. We've got further to go. So something I always do when I'm looking at longer term charts in this way is, as a quick sanity check, I want to understand the relationship of where the passive trading has been. So this tells me, and look at all this blue delta here, as we opened here, passive sellers were really trying to resist buying going any further, and they got it wrong. Here, we've got passive buyers who are looking to prevent aggressive sellers taking it lower. This is totally the wrong way around. We're not in balance here. So the story we've got is we're going to try and keep this down. We're going to try and keep this down. Oh, it's wrong. Okay, we're going to go further. And this is where the market was being held. And look where we closed. So you start to look for the big levels of delta in longer term candlesticks or on a session profile, and it's telling you where there are areas that you can lean on. Now, of course, it will change during the day. One of the challenges on your platform is that the daily profile is only going to give you a snapshot as of the end of the day. But it's very interesting to watch the progression. Or take a 30-minute candlestick and add across levels, so 619 minus 323, and start to get a picture of the net. And you can start to understand how, in quotes, support and resistance develops and breaks or holds. So if we have got things the wrong way round from the perspective of the limit orders, then I interpret that as we have further to go until we can actually get a sense of order within the market. This comes back to the idea from Dalton that it's other time frame traders. So right now, the other time frame traders are not in control. We've got to go further until they can exert control, because we've truly gone too high. And we've either run out of aggressive buyers in this case, or the passives have overwhelmed them. Sometimes we see this situation, and it actually doesn't matter which way around they are, but we have the largest positive and the largest negative delta sitting on top of each other. I call this contested level, because this is telling me we've got a huge battle on both sides. So we really shouldn't be doing anything here until this battle resolves itself. How do we know how it resolves itself? Price. We don't know where we are. Now, look where this battle was occurring, right in the middle of this upside down range here, which was created by the aggressors. So we went, this candle went higher, got positive delta at the top. We've come back down, looks like it's pretty strongly. one tick below where we were looking, well, you know, strong buyers, strong passive buyers were looking to hold it. We had a battle just above where people got it wrong. But we closed to the downside. So that now tells me the fight happened here, but the result of this fight is we've closed below it. I'm no longer feeling so bullish about this. So we can read the story about a range, very orderly range that got broken, aggressions in control, because this is the wrong way round, and we can understand the story of what happened at each of these price levels. We went higher, there's a fight around this level, and now we've closed below it. So it then becomes very interesting to track this price level over time if we get back to it, because it will likely come, well, it will likely be another battleground when we revisit it, if we revisit it during the session. So this is how I like to use delta at price to really get a sense of what is going on within the auction. And delta at price for me is incredibly powerful and much more powerful than thinking about delta for each horizontal bar. With delta at price, you can quickly look at the session or a longer term candlestick and start to understand ranges and who is in control. That may have been a bit heavy, and we may come back to it. We're going to go heavier still. How can we now put all of this understanding together? And it's understanding of the concepts of the pullback delta, so the net buying or selling that's occurred since the extreme of the bar, and also delta at price and the fact that all candles are wrong, and we may well need to aggregate up volume and delta across multiple bars. So this is quite a complex worked example, but it's how I start to generate trading ideas and indicators and bots for automation, which are purely based on the volume that's traded, because volume moves price. So let's talk you through what's going on here. And this was yesterday. This is Friday on ES at the low of the day. So what I've got here is a 30-minute candlestick. And at 12:30, I've highlighted a pattern, and the next clinic's going to go into some useful and significant patterns on traded volume. What this pattern is telling me, though, is we're at the low of the day. We have got exhaustion of aggressive sellers. We are running out of aggressive sellers as we reach the low. The delta through this range of exhaustion was negative, so minus 370, 643 minus 1013, plus 7 minus 107 gives us minus 470 delta. So in this area of selling, 470 contracts, 470 more contracts were sold than bought as we were running out of sellers. So that kind of tells me how much volume is offside. Yep. And that's my starting point of something to be interested in. I've got a pattern which I like in traded volume, and I've qualified how much volume is offside. Here I'm zooming in, and what I've got here is a 4-range chart. I'm not using a time-based chart because I really want to capture simply what's happening across different prices. So let me talk through the calculation that's going on here. Here is the rundown from these price levels to the very low. And you can see the bottom print is 107 by 0, 107 by 0. We only traded in this arbitrary period in one bar at this level. This 693 by 700 is formed by 139 and 554, which is 693. 79 plus 621 is 700. So this concept that let's crunch these together and we can read the volume. Hopefully that's clear. Yep. And this negative delta through these 3 price levels of negative 470, we can see that's comprised of negative 727 from this candle, plus 357, positive, same price level here, because I'm using a range bar, minus 60, one below, plus 67, minus 107, tells me that across these 3 price levels, there's my negative 470, which I've highlighted here within the 30-minute chart. So I can zoom in across these two bars to understand what's going on. Now, what gets interesting for me then is the concept of the pullback volume. Now the platform will tell me the pullback from the bottom. I'm not so interested in that. I know I've got 470 offside, and as soon as we come off the bottom, what's actually going to happen is this was probably larger, negative 600, but the positive delta, as we've come back off, has reduced it. So I'm only interested in what happens once I'm away from this pattern, which has got my attention. I call this pattern a price projector. We'll go into that more in a later clinic. So we know these three price levels are where we've got our minus 470, which is offside. What I'm interested to know is, when do these minus 470 liquidate? Well, as we trade up, because remember, time is moving from left to right. So we came down. As soon as we tick up here, we're away from this pattern. We've got 111 net delta. So 111 contracts positive has reduced that negative 470 offside. Then we've got 124. We form a new candle, that's just arbitrary. We can see we've got 111 here, plus 124 here, plus 18 here, plus 157, plus 78. At this point, B, at the time we trade at this price level, 488 positive delta. All of these offside contracts have now been neutralized. We're net plus 18 relative to that. So this is the point where we could say if everybody had puked here, we've got here, allowing for back and forth. Now, what I can also see is that at the close of this candle, so I'm plus 18, 488 less 470, so at this price level, I'm net 18 contracts up. If I add the 217 and 77, I'm now net 312 contracts long from the point where everybody was out. And this is like hitting reset in your dome, but hitting reset at the absolutely perfect time. This candle actually had negative delta, so I can simply say subtract 180 from 312 at this position, I'm net 132, but we're still net long compared to where we were down here, even though this, well, after this has resolved itself. This candle came down into this area. As it closed, I'm still net 88, even with negative delta. Now, a few things to note. I mean, we came down. Look where the areas are of the lowest delta here. That's where we traded to. This was our inflection point where the 470 netted out to 0. And look where the largest negative delta was. It may be a coincidence, but depending upon how you like to visualize this stuff and how good your mental arithmetic is, or how clever you can tweak your platform to do this stuff for you, you can now really start to understand what's happening when we have got contracts which are offside at an extreme, and we can now read the whole story of what's going on. And one of Jeff's phrases is that good trades work out quickly. Well, I think we're all guilty of getting into trades either with hope or FOMO, and we get in too early. Here's a way of really finessing your entry based upon the volume. And what's the right answer to do it? Do we want to see the situation play out and maybe then start reading the delta after the situation's played out? So here, if I thought I want to wait for these 470 to clear up their mess, and then I'll think about getting in. They cleared up their mess here. But actually, if I enter here, I've got no one who's trapped. If I enter here, okay, net 312, that's quite a good sign. Could enter here, but I'm quite a long way away. As we've come back down to the area, if I'm tracking the net position, I can think, now we've got a good story, because even though 470 contracts are offside and they've washed out, we've still got positive delta. So you could have a low risk entry here, or you could be more aggressive, and we could be tracking from the 470 as they wash through here. So let's think this is the cumulative delta since the 470. I've got 111 here. Add 124, that gets me to 235. Add 18 here, gets me to 253. Add 157 gets me to 410, etc. How does this cumulative delta, since I get away from this area, relate to how much was trapped? Well, the 111 is 23% of the volume. 111 plus 124 is 50% of the volume. I have a little algo I run, which says, if I have got the pattern which I like, and I know I've got offside volume to a certain level, if the pullback is, also rather the net pullback, yep, if that is 50% or more of what's there, then I'm happy to go in. So my algo would have got me in somewhere around here. So beautiful entry on timing. I could potentially have just got out for a point within how long? No time, under 10 seconds. So that's good trade working out quickly. Even if I'd held it, I would have had 0 adverse excursion. And a lot of this depends upon how you're able to actually use your platform, use your mental arithmetic to run these calculations and finesse your entries. So this horizontal example shows you the mechanic. In reality, I'm looking at this vertically, and I bring up the net pullback volume here and its ratio. My algo is monitoring the same thing. But you can start to read this simply vertically from the extreme of the candle. And this is analogous to if you were watching this in the dome, you get to the bottom, maybe come off the bottom. If you hit reset here, if you started to see positive delta, you'd enter. So it's exactly the same set of information, but we are visualizing it in 2 or 3 different ways. So what I encourage you to do is really embed the mechanics of what's going on here in the delta, really understand it and embed it, then it becomes a blink. And that's why Jeff can just trade off the dome, hit reset, hit reset, hit reset, and get in quickly with very little MAE. It can take a while. Like I encourage, break it apart like this. Find inflection points, track the offside volume, understand how that volume's played out, and then you can condense it back into a simpler representation, and you've got your blink as to how to enter this stuff. But I hope this reinforces that you've got to think vertically, and you've got to consider delta at price and the relationship of price versus delta at price in order to understand who's in control. So, as a quick wrap up for the Q&A, we've covered the basics of delta, high delta and low delta, and where closing delta is relative to that. Pullback delta, really important, and we've also explained why we don't refer to it as the phrase, which I'm not going to use again. We've covered delta across bars and delta divergence, but it's always late, so think vertically. Remember the phrase, delta divergence is horizontal exhaustion. We have got to think vertically in terms of what we do. Delta at price is extremely powerful. It tells us the outcome of the battle at every price level. So if we can read the outcome of the battle at every price level, we can now determine what our actions are, whether we are swing trading and we're looking to be aligned with the more powerful passive traders, or if we're scalping, where we want to join the aggressors who are taking control and pushing the market in one direction. And finally, we've looked at how this all plays out within the market's microstructure and methods you can use to turn this implicit understanding into blinks that you just act upon. So we've gone from the very basic, broken it apart, and got into, frankly, more complex than you're going to see anywhere on the web. That wraps up the formal stuff within this clinic. I can see David said the last 3 slides I've got an understanding, but I don't fully grasp yet. I don't expect you to fully grasp this. You need to watch this and examine this really closely in your platform and reverse engineer the understanding in your head. It took me several months to really understand the importance of delta at price a few years ago, and that was how I embedded my understanding of absorption and the importance of limit orders, and for me it's fundamental. So if this has blown your mind a bit, I'm not surprised. I did say bring your biggest brain, and I encourage you to rewatch this because this is important stuff to embed, but it will come.
Okay, excellent job, Lee. I'm really good information, really good questions. I'm just stretching for a second and trying to consider the best place to start. And let's do a couple of things. Let's see. I'm going to take the screen back. Give me a second to do that. Okay, so I'm going to just kind of go through the questions the way they came up chronologically, because a couple things came up, and I also want to clarify, because like you were talking about COT, and people have asked me about stuff that shows up on my footprints, and so let's get through that. And then there was a couple of good questions at the end about the profile, pullback highs and lows and whatnot, and then we can talk about that. And also one other thing, while you were talking, I made a quick MZPAC Delta footprint to share with everybody.
Cool. Yep.
So for those people that are using that, you can see a lot of the principles you just demonstrated in a very simple way. It's not quite as much information, but it's again, from a scalping point of view, it's exactly what you would need to see. So let's do that. Anyway, let me grab a chart and throw it over here. Okay, so this is the familiar footprints you guys have seen me throwing up during sessions, and this is the one that's got the oh, come on, Jeff, the unfinished business. That's what the boxes are at the top, the yellow box there, and this one down here. So I updated this based on the last session we had on Saturday that Lee did, and I think that's a really cool filter, by the way, just to mention it. Anyway, the numbers I have on here, I have referred to various ways as well, and again, I just want to clarify, in MZPAC, the definition he uses, I completely agree with Lee, and I also am familiar with Gomi and what he does, and you know what, as far as I'm concerned, if you're going to use MZPAC, the best way to set that up and the best answer to that entire conversation is, and first of all, before I do this, COT is the Commitment of Traders report. Anybody over 40 will tell you that, okay? A bunch of new people came in and started stealing these terms, and that's what Lee showed you on that slide was classic, because commitment of traders is what the COT is. A lot of people have tried to make it other things. Anyway, in MZPAC, if you're using that, here's what I would suggest with respect to this. And again, just because there's a few of us that are. If you look at their footprint settings, this is the most recent version, they have a few different places where you can turn it on, like in the bar statistics. And I would encourage you not to use any of the COTs in here, but instead on each particular bar, you'll see I have, this is the delta, so like this 1923 right here. Let me see, turn on hold on. Why isn't it letting me? There we go. Okay, I wanted to turn on the crosshair so you guys can see where I'm pointing. Okay, there we go. So if you just pick any particular bar, this right now is the delta, and this is the total volume. And then these two numbers, which you can make be the COT or any of this other stuff, keep it simple. You'll hear that over and over for us. What I am doing with that number is I am simply using the high and the low of the delta, okay? So on the top of the bar, I've got the min max, that's what that is. And then down on the report on the bottom, I'm simply showing buy volume, sell volume, cumulative delta. You'll see in here those COT things, and again, I agree with.
No audio, Jeff.
Oh, do I have no audio at all?
No, you're back. We just lost you briefly.
Oh, okay. So how was did I finish the part on what I was showing and not showing?
You're showing min and max delta. So you're showing a candlestick of delta in numeric form.
Exactly what I'm doing. And again, the COT terminology in MZPAC, the reason I wanted to show you this is I don't agree with the terminology that MZPAC or Gomi uses, and the best use of this information, kind of consistent with what Lee was talking about, is to just show the high low of the delta, where the delta ended up, the net, and I think that's really useful. Now, having said that, While Lee was talking, I made something else that I have used in the past. I used it when I was using Tradevate. If you remember back in the day when I was testing that on the Top Step site, those of you that were there. And this is simply MZPAC with just the deltas. And this is a really good way to emphasize what Lee was talking about, how at the turns, going up, you'll see all the buy side delta, and then it will kind of peak, and then it starts going the other way, and you see all the negative deltas, and consolidation is the rainbow, as I call it, the rainbow flop. It just goes back and forth. And then you can see the aggression pushing us down, and then that aggression goes away, and it becomes buying aggression. So this is a really cool way to do that in MZPAC if you want to see that. I am working on putting up the volume at price footprint thing for people on Ninja. I will see if I can make that happen. So that was just a quick thought. I didn't have time to do it while you were talking. But this is a cool template. I'll share it in the group later on. So that's what I wanted to say about the COT thing, and just a delta footprint, which I've always found really, really useful. Now, if we could switch to the question where we got into the next thing that came up was when we started talking about, so we went from there to profile delta. And again, I'm going to talk more about profile delta for Ninja. I'll come back to that, but it won't be during this session. But then we went to the question and the discussion of pullback, highs and lows. And there's a bunch of questions in there. So Lee, if you could address at the very bottom of the chat, there was just some conversation. For example, Jury says, is there a way to use high and low pullback in a meaningful way on, say, on a 5-minute rotation, which I think is a really good question.
Yeah, so...
Do you need the screen back, by the way?
Yes, I'll do that. And I might do a couple of things to the screen. Let's think about this. Let's ignore 5-minute rotation. Let's just say rotation. Yeah, so something...
Yeah, rotation in general.
Yeah. So
and that's a good emphasis. Let me emphasize something there. We're doing the radio show thing where I can interrupt you. What Lee just said there is critical. When you're doing any analysis, all time frames are wrong, and you got to just pick one. That's really the moral of the story. Anyway, go ahead. I'm sorry I interrupted.
And actually on that idea, Jeff, I like 30 minutes so I can look inside TPO rotations, market profile rotations, and it's long enough to really aggregate up some volume on things like ES and on CL. If you're using 5 minutes or 4-tick reversal or 10 range or 8-tick, who cares? Get really good at looking at 3 or 4 bars that are next to each other and aggregating up the overlapping volume so you can get a picture of what's going on, because your 5-minute, Jerry, is wrong. Yeah, all of these artificial horizontal divisions are going to distort the volume. And what you care about is, what is the volume doing at price? That's what we're doing when we're interpreting traded volume. So on 30 minutes, I can trade swings within market profile, and trade the range and this kind of thing. On full range 5 minutes, I may or may not be able to do that, but it might be that 3 or 4 bars in aggregate enables me to do that. So if you are locked into 5 minutes, firstly, don't be, get over that, and get really good at reading across overlapping price levels to build the picture out in your mind. So what's happening here? Yeah. If you start looking at this versus this versus this, and what's the shape, you're too late. Yeah. You're letting time pass. Now, we could have exactly the same information that's captured in here, reading vertically in the dome or in a long candlestick. So lose the attachment to XYZ period chart. So is there a meaningful way to use pullback high and pullback low on rotations? Yeah, there are several meaningful ways. Let's try drawing this to understand it. A lot depends on what my trade plan is. Let's say my long-term candle is auctioning up and we're currently trading here. So we've come up and we're sitting here. What I'm going to have within the pullback is lots of volume information on the way down. So I've got volume at price and delta information going on. If it's my desire, for whatever reason, to be trading in this direction, I'm going to be looking at this as no different to, well, it'll be like this candle here. I'm coming down from the high, so I'm going to be assessing the bottom of this to see if I've got an opportunity for re-entry, springs, upthrusts, whatever we want to call it, but I'm reading the volume. So depending upon what my plan is, if I'm trading up for whatever reason, as I come off the high, I'm looking for my entry condition at the bottom of the pullback. I'm assessing this rotation back down to see, have we exhausted? Has it exhausted? You know what? Maybe it's done that and it's wiggled up here, but its prevailing direction is down. Maybe this is unfinished business. Maybe it's going to get a bit lower. Maybe there's some stupid arbitrary level here which might be acting as a magnet. So one way is, if we're pulling back from a prevailing direction that interests me, think about the bottom. The other way of thinking about this is, we've gone up to whatever high of the day, and there are some patterns within here that tell me it's too high. Patterns, like this or like this. We're going to be, whoop, that's terrible. And we'll be getting into some significant patterns in traded volume actually in the next clinic. So if I'm up here and this starts to feel like it could be a high and a potential reversal point, then as the pullback starts to occur, which naturally is in this direction, I'm going to be interpreting the delta, which is what this example is all about. So even very simply, if I'm at the top, which I think is a top, and the delta of the pullback is negative, well, that's telling me that aggressive selling is in control. I might want to qualify that with how much aggressive selling versus how much aggressive buying was in here, but I am treating this as confirmation that the reversal is on its way. So, TLDR, if I'm looking to trade continuation, I'm looking at the wrong end of the pullback for a sign of entry. Yeah, I want the pullback to run out. It's retracement. If I'm looking at reversal of the prevailing direction, then I want to see momentum, so delta, in the opposite way, the way in which I'm planning to go. Hopefully that provides a nice clear answer for how to use pullback.
Okay, good. That is a really good answer. And one of that, just something that was occurring to me while I was watching that, again, about the not thinking in time frames, and also how this answers sort of the question a lot of you have asked that are in the group right now about, when do you reset the dome? If you kind of think this way, your instinct when to reset, if you're using Jigsaw, will kind of naturally head this direction. I know a couple of you said that in the text chat, and I really encourage you to just keep playing out that exact same thing you were talking about. Just keep testing that, and it's about teaching your brain to see it. And you get to the blink, but you don't get there quickly. So you really have to, tell your mind what it's looking for, and then spend lots of time staring at it. How much time? That's a good question. We did a survey about that. Lee, how much time would you say it takes, looking at this kind of display, the graphical interface of a footprint chart, to start to understand this stuff? Obviously everyone intellectually can understand what you're saying here. Oh yeah, I get that. That's the ahas. But to get to the point where while it's happening, you can just see it. How long do you think that is? Obviously it's an opinion, but
it's months, definitely. The way I got into it, I'm probably going back 4 or 5 years now. I remember I was trading ZB, which at the time was my favorite thing to trade. And I remember selling the low, which actually I was happy about. So I was confident we were going to go lower, break the initial balance low or whatever, and it didn't happen. And for the life of me, I couldn't understand why it didn't happen. Everything looked right. And that's when I changed my footprint view in Sierra chart. I was still using stupid horizontal charts. And I pulled up the delta for each price level, because I couldn't work out what's going on, all this aggressive selling. And then I highlighted the min and max, like I've got here, but the min and max delta. And I saw the same level across several chart bars that must have been the minimum delta. And the penny dropped for me, that this is where the aggressive selling was happening all the time and we didn't get lower. And that's when suddenly I understood absorption. But it took a really bad offside trade that I couldn't understand to get me to dive in deeply to it and understand the mechanic of what was going on. And that's when I realized, and I remember I produced an indicator at the time for Emoji, which I called absorption sequence. And the idea was, let's track, but if you look at the deltas like this, and you don't know what you're doing with all these min-max, you can't, there's too much information. It's way too much information. You can't read it. So I was filtering the min and max when they're occurring at the same price level across a look back period. And that's when I started to realize my horizontal charts were wrong. What mattered was the volume occurring at each price level. So it was the process of uncovering why a trade didn't work, filtering the information that the platform was doing, that really got my understanding tight on the mechanic of what was going on, and then I could start to see it. But it then took months of seeing it in the right way on footprint charts and configuring them in the right way for it to be a blink to just look at it and be able to tell the story vertically of what was going on. Are you there, Jeff?
God, my mute, hello Zoom, they're doing it again. I'll unmute myself, and then as soon as I move the mouse away, it magically remutes. Okay, can you hear me now?
Yes.
Okay, all right, what I started to say was, as you were talking about that, it occurred to me that one of the things that I found difficult to learn footprints, and I see a bunch of you asking questions like, and I've got a few privately too, how much computer do I need to do this? And how much time do I need to learn it? So I want to give two answers to that. First of all, from my point of view, if you start with less in footprints, it's easier to learn, and then you can always add more information. So I want to just show you real quickly, and this is how I learned my most significant use, and then since I've added more stuff to it. But my early footprints were, this is NQ is going to be too hard to see because it's all over the place. Let's use ES. Again, if you just look at the deltas and have nothing else on it. So, these are mine that are, the bid and the ask, and MZPAC doesn't do a bid and ask and delta next to it like yours is showing. So you either get one or the other or some combinations. But one of the things that I like about, so this is my scalp view, where I'm looking at imbalances, but I'm still seeing the buying and selling on each side. And that kind of gives me a sense of levels of supply and demand, like what you were saying. And but I recalled, as you were saying, that the way I got to this step was with this step right here. And I literally just was looking at deltas. And it's a real good way to get an idea. And I'm going to Jerry's question. I think it was a Jerry that asked it about the flows back and forth and the rotations. Whoever asked that, I think that was Jerry. Anyway, here's just like 30 seconds. And if you just watch the delta and nothing else, here my deltas are red and my positive deltas are green. As it comes into a level where it turns, it's really pretty obvious. The selling's heavy, it's heavy, it's heavy. It pauses a little bit, it gets heavy, it takes a new low, a little pause again, another heavier low, and then it just sort of dries up. And again, these are 30 seconds, but if you learn to just look at deltas, it can be really informative. And then, go on and add, what's going on either side of it can be really useful to understand the bigger picture. But as a scalper, I have found that the delta alone is a really useful thing to know. So anyway.
And that makes total sense, because as a scalper, you care about aggression and momentum. So exactly. The delta is telling you that snapshot of what's happening right now in your 10-second, 30-second time slice, and you'll just go with it. And when that momentum stops, you're out. And what I've found as well in the footprint, I think these sort of medium time frames, 3 minute, 5 minute, 4-tick reverse or whatever, these are the time frames on footprints that are a waste of space. I think you go long term, session, 30-minute, this kind of thing, or you go 30-second. So you want to be very slow or very fast. Stuff in the middle is just stretching out the story horizontally.
Totally agree with that too. And that's one of the reasons that almost all my charts are very fast. The idea, and the 30-minute after you did last week really, as I've said a few times, really became a good filter for me because I'm in scout mode, you know? And if I'm seeing lots of aggression and we're heading away from a level that I know has unfinished business below it or above it, you know, conversely, then I start thinking, okay, you know, I'm scalping the right way, but I really have to be prepared for a turn here. And it's funny because I used to not really worry about that. I think, you know, I'll worry about that when we get there. But now it's giving me a better idea. And this particular format, and by the way, Jerry told me privately that there is a way to do both this and the delta next to it. And I asked him to send me a template. I think you can get similar, Jerry, but I don't think you can actually do the same thing as well as the imbalances that I'm doing here. I may be wrong, in which case, you know, I'd love to see it. I haven't played with it enough to really know. But one point I wanted to make about these deltas, which, you know, you can see on either of these, my primary thing as a scalper, again, is about imbalances. So the deltas, if you look at this, this is, you know, on a 1 minute here. Let's look at this a couple of different ways. If we go to a really fast time frame and then compare both the footprint imbalances and or the deltas, you find that it gets really intuitive for scalping. And up until this point, what I've been doing is using imbalances because I find those work the best. But I forgot that I had started with deltas when I first started doing this. So anyway, because I'm also running Zoom and everything else here, this may not populate as fast as I want it to. Somebody was asking about how much horsepower do you need? I've got almost as fast as you can build, and this will take some time, probably because I have too big of a, there we go, okay. Yeah, this is, the data feed is not running right now, as I said earlier, because Rhythmic is doing maintenance. So it's pulling this up from mine. But all right, this is what I wanted to show you though. If you just strictly look at imbalances on either side, and what it does is it kind of just paints next to those. So the pinks are sell side imbalances and the buys are buy side imbalances. So when you get to a level where we're going to turn, you know, one way or the other, you start to see that come in. So here you can see the sell sides continuing to push this down, and then we kind of come into some buying and whatnot. So that's the way, if you just look at it from the imbalance point of view. And then each one of these bars has a delta on it too. That's what the number above or below. And you can see negative deltas coming down, and then they turn positive, and guess what? That happens to be the inflection point. So very fast time frames, or just looking at deltas, again, on reasonably fast time frames, can give you really good scalping opportunities. So I just wanted to reinforce that. You know, a lot of you guys are in the scalping mode. And so these are all great different ways of using the same information. And again, different platforms produce it different ways, but that's more of a personal preference. It's understanding what's underneath the covers that really matters. Okay, some other questions came up while we were talking about that. So let's pull those up. Are you good on time, Lee?
Yeah.
We're going for a while here. So, okay, Alex is asking a great question, and I'll answer it, and then I'll let you answer it. Alex asked, do I switch to a more focused footprint in order to see the strength of the footprint? And my answer to that is never while I'm trading live. I've kind of done that in advance. You know, like I know there's unfinished business out there on the 30-minute, but, you know, I'm looking at 30 seconds because I'm scalping, and I'm really even not looking at the footprint. I'm looking at the dome because that's where I see 30 seconds. So that's my answer, but yours, you know, might be a little different. What is it?
I think it depends what Alex means by more focused. So for me, my primary chart is a 30-minute footprint with pullback. So, okay, so Alex saying faster. No,
yeah.
Exactly the opposite. I'm treating a 30-minute footprint like the dome, and the pullback is like I've pressed reset at the perfect point in the rotation. So I'm letting the platform and the formation of this long candle, which, you know, on ES is going to be what, 10, 15 handles early in the day. I'm letting the platform be my reset button on the dome. And the way I configure Sierra chart is I've got 30-minute footprint. I have the dome on the chart perfectly aligned to it, so I don't need to look across to a different area of the screen and, oh, you know, I've got to move my mouse up 3 inches because the prices aren't aligned. but I'm using this slow view. I may have another chart which is faster if I really want to look inside the extremes of what's going on, probably something like 4-tick range, something like that, so I can easily overlap the price levels. But my focus...
Lee, can I just interrupt you for a second? People are thinking that you're showing something. If you are, you're not sharing.
I wasn't sharing anything. But
okay.
I'll put mine back up so we've got something
guys.
to talk
No, that was
to.
a logical question, though. You weren't supposed to be seeing anything. He was just talking.
Yep.
But now he's going to actually show it. So
it's
hard to follow a topic like this without a great deal of coffee. So
so I will be trading off the left-hand chart with a dome immediately next to it, and I'll be seeing the pullback column as well within there. But that's no different to me using Jigsaw with the current and recent volume in there, and each time it gets to a high and it comes back, I've pressed reset. It's the same thing. But switching to more focus, no, I want to read the aggregate volume and understand the patterns that are going on. I don't want to zoom in, because zooming in horizontally is a waste of screen space.
Okay, good answer, good question. One thing I'm doing real quick here while we're talking, so give me just another half a second. My machine is working very hard on your behalf, everybody. All right, so Lee, I'm going to take the screen back here for a second. We're actually getting reasonably seamless at this stuff, so how about that? All right, so, all right, you guys should be able to see this 10-second footprint I just made. Yes, no, anybody? Hello?
Yep.
Okay, you got it. All right, so, and yeah, Jerry is sharing that, these really fast footprints, if you're a scalper, basically what ends up happening is, I don't have it up right now, but let me just pull it up because the market's not open. I can't show it to you live, but let me just show you an example in the Slack like I did a minute ago. If you, if I'm looking at this right here, what Lee was referring to with the current and resets is that you can reset any of these columns individually or all at once. So you're constantly building little mini footprints in Jigsaw and right on the dome. And so the value of something like a 5 or 10 second footprint is dubious at best if you have the skill of reading that. Now, having said that, getting the skill of reading that takes a lot of time. I never answered that question, but my answer was it took me a good 6 months of staring at footprints and domes to really understand, that this was really the same thing, and that, I could watch it up and down as much as I want there and frame my context. So, for example, having that, and then over here on my left monitor, having the 30-minute footprint as a context view for my brain, that's my answer, Alex. So, I know this is going on, but I don't need to see this right now because, I looked at it 10 minutes ago and it hasn't changed much. So for me as a scalper, it's much more about what's happening instantaneously. However, that's not easy to learn if you've been staring at charts your whole life. And so what I found easy to do was this, and this is an example of, I made, and there's a bunch of posts about it in the Top Step group last year, but in the Tradovate platform. But basically I just made delta footprints like this, and I just started watching really fast intervals, like 10 seconds. And this kind of a thing you could easily, shrink down and put next to your dome, and it will help you break the habit. It kind of like linear regression channels will, and it does give you good information. When we are in fact trending, let's pull up a situation where that's true here and just kind of look at it. Well, we need to go further back here. All right. Hang on. I need to. The open is always a good example of that. So let me just zoom back there. Where it's just really aggressive one way or the other, that can keep you from losing track of when that aggression stops. And, and when we're getting the turns, so like a first hour high or low, this can be a really useful tool to have up here. So look what I'm doing. I'm just kind of fast forwarding through it. And you can see, everyone kind of thought there was a level there, and we went away from it, but we did, we were coming down pretty aggressively. I mean, look at all those deltas. And again, this entire bar is only 10 seconds, yet we managed to have a minus 1,000 delta, with just nobody looked back, and then it looked like, oh, maybe some buying is creeping in here. Nope. That's what a sweep looks like. I mean, they just took out from 48 to 42. And, if you were trying to buy into that, you got crushed. But when that kind of behavior stops, you can often see an entry. So whoops, I didn't mean to hit that so hard there. All right, so you can see right here, let's just do that. So that sold down pretty hard, and you could have momentum traded that anywhere, from even right about here down. So obviously the 10-second footprint could teach you something. But if you can learn to see it on the dome better, here's an example of what I wanted to show you that it's particularly good at, is seeing this kind of a point right here, where a big hard move down, and then there is some follow through, but then you start seeing these buy side. That's why it's blue here. Those are the buy side imbalances, and you can see it in the totals down here. And it really never looks back. And there's your pullbacks. They do show up there. So,
I think, Jeff, these charts are the training wheels for reading the dome or a very slow footprint together with the pullback data, because at your inflection point at the low, I can see there's some positive delta.
Yep.
And if I was reading the statistics summary at the bottom, I'd see a pattern. Yep. But look how much screen space we've wasted to get to that point, whereas I could just be assessing across 3 or 4 price levels. Oh, we're bouncing around there. I can see deltas moving up, boom, I'm in.
Yep, exactly. I completely agree with that. And it's so, for everyone individually, you have to, for lack of a better way, you have to determine your training wheel-ness, neediness. If you need more training wheels, put them on. The same opinion I have about the linear regression on the really fast charts. I don't use it anymore, but it overwhelmingly got we had 55 people in the workshop, and nearly everybody was stuck until we got there. And then like 30 people had aha moments in 5 days. And most of those people aren't using linear regression anymore, but it got their brains over the hump. So anyway.
And to David's point he's just made, these charts make way more sense than a chart. I cannot read a candlestick chart with delta underneath it, as red and green histogram. It takes my brain backwards and I don't understand what I'm seeing. I need to see the footprint, and I'm reading it vertically looking for patterns, and then I know where I am. So once you can get to that level, you probably find you go back to your TA from 2 years ago, 3 years ago with candlesticks and head and shoulders and wiggly lines, and you feel lost.
Could not agree more. Okay, let's see. Thank you, Alex, for confirming that that made some sense. That's good. Again, feedback real time is always useful. That way we know if what we're saying is at least resonating. And God, I cannot emphasize this last point enough. And, I'm sure Anita will attest to it, and a couple of the other folks that are newer, but not quite as new. Brent's another one. If you just kind of clear your head, guys, tabula rasa, and just, put on the back burner everything you think and just watch these videos and just think about what we're saying and just kind of let that sink in. And then, watch it for a few days. And trust us, you'll have aha moments. It will work. Okay, let's see. That's the link for that. Okay, just looking at other questions. Thank you for posting that. David, that's not a legitimate question. Will yours be better? Lee's a great coder and he's got some great ideas, and it might be the best thing in the world. When it comes, we'll all play with it and we'll give him honest feedback. But that's the same reason that I beat up one of our members about just coming in and saying that you could use like Tony Robbins kind of think your way to success. You can't. And bless his heart, I love Lee, but we'll see it when he produces it. It's you never marry your tools or your partners. Okay. Would you agree with that, Lee?
Yeah, totally. And just to qualify this, what Emoji has going on, and I'm really strict. And TRG, I'm not here to promote Emoji. I may have some emoji indicators on my examples because they are time savers for me, or they let me illustrate points more easily. But as my coaching clients who are in TRG will attest, I teach people to read stuff from the raw data and actually tell them how indicators are doing their thing, so then they can understand how to use this stuff as raw material. But to be clear, what Emoji is about highlighting patterns within the traded volume, within the footprint, and tracking that over time. So it's time savers and productivity. That is on top of a footprint. Now, on our NinjaTrader product, we will release a free footprint because NinjaTrader binds you to the lifetime license. So it's a way for Emoji to get more people in because we'll have a free footprint. Will it be better, worse than MZPack, Gomi, whatever? Well, these guys are combining both a footprint and add-on indicators. So Emoji will release a free footprint, might be 1 column, 2 column, don't know what it will highlight, we'll see. And then separately, there will be add-ons that allow you to highlight certain useful patterns and track those over time. Will it be better? We'll see.
Cool. All right. And, by the way, it always is subjective. A tool that's useful for me maybe is not useful for you. And, it's always personal preference. So it's really important to focus. And this goes back to even something that Kevin said all the way back at the beginning. This goes back to focusing on that back and forth between fundamental knowledge about what price action looks like and then trading with different tools and trying different things and that exploring and playing with tools, and then that's how you find your Bubba, to ask, to say, will it be better, Lee, for who? So that's, I'm not criticizing you asking the question. I'm just trying to get you to understand that that question is the wrong type of thing to even be thinking. What will it be capable of doing? Will it do it well? And is that a thing that will make your Bubba more bubbleable?
It's like buying a new computer. If you need it now, you buy it now, and you can always put it on eBay and get something else.
Yeah, and this brings up something else. We talked, Lee talked about the volume, the delta at price, and right now, as far as I know, there's no way to do that with the order flow tools in Ninja. You have to buy a third-party product to do that. MZPack's volume profile does that, and that's an add-on. But I don't think the Delta lifetime license volume profile is capable of delta at price. It's not very sophisticated. I do know that what's-his-face, D-Values does that, but it's really hard to use that indicator because the settings are so crazy. There's thousands of them and they don't make sense. Because that was written by someone that's not a native English speaker, and it was not translated well. So, again, if you're looking for that, I'm just circling back to that question, which came up a lot. The Sierra Chart product and Lee's products are great. If you're on Ninja, you might want to take a look, unless somebody correct me, if there's a way to do it in the lifetime license order flow volume profile, let me know. I don't think there is, in which case, look elsewhere. But that's good to look into. That's something I've used in the past too. I did use that with Gomis and with, what's his name? Finaug. I don't know if you know him. He's another guy that has a nice set of tools. And he has a really nice volume profile add-on for Ninja for like $100. And it does some of this stuff. So again, I encourage you to go tool shopping and play and use free trials.
And Rancho De Niro has good stuff as well.
Yeah, Rancho, yeah, somebody mentioned that. I guess it was Blair was using that, yeah. And so a lot of that stuff is free or close to it. One thing that I would be strongly encourage you, if you're gonna do any of that, is to make sure you have a test environment to run on. Don't put it in your only live trading Ninja platform. Run virtual machines, or I literally run a separate physical computer to test on, because that way it never takes me out for a year at a time. And I've had that happen where something just gets so badly broken that I just can't get it fixed. So virtual machines, that's a huge lesson. Yeah, okay, Jerry's saying that MZPack has delta at price on the volume profile. Yeah, I know it did have that. I have looked at it before. I may look at it again as something to do this weekend. We'll see. But that is a useful tool. It can be, certainly, depending on what you're doing. All right. And by the way, if you're thinking that the screen's black, yeah, right now it is. There's nothing being shared. So other questions or comments? We're going into almost 2 hours here, which is fine. Just try to keep it reasonable. The one problem we are having is Vimeo is taking forever to render videos. So we will get this one up, but it could take 24 hours, 48 hours to get it up. So please be patient. All right, just scrolling back through any questions I missed, and I don't think I did, but let's just take one more look. And then while I'm doing that, I will just open it up for anybody have a burning desire, have a question they just cannot leave. I will take it. Lee will take it.
Yeah, I'm scrolling through as well. I think we've covered
hit it.
stuff. Yeah.
Yeah.
So this is going to be one where you will want to rewatch it 3 or 4 times, or watch a particular 10-15 minute session again and again and again, which doesn't surprise me. And I said this would be a deep dive. Some of these concepts change your way of thinking, but once you've got them, you will reach another level in terms of your trading.
And again, I will admonish you guys to watch it 100 times if you have to, but every time that you do, if you have that mindset that I've encouraged you to have, try to just get a nugget out of it. Don't try to understand everything. Don't try to build yourself 5 new footprints that are going to do everything Lee said today, because I'm going to trade this starting Monday. That's the wrong answer. The right answer is find one thing that resonates with you right now, with a situation in your trading that you're trying to work on, and focus on that thing and improve incrementally.
Yeah, like if you've got a platform where you can see the highest and lowest delta within a candle, pull up a 30-minute footprint, highlight the highest and lowest delta within the footprint, trade the range. There's 2 weeks of homework.
Okay, awesome. All right, thank you for the feedback there. Yeah, David, it's real easy to just want to eat this stuff up, and that's always about balance. There's, it's the rabbit hole. You go down and it just keeps going, right? And again, I would go back to that concept of balance, and breaking your day up into sim time and play time with new ideas, and optimization time, and then live trading time if you're trading live. And I would also really encourage you, a good way to frame all of these things always is this. Just going back to the Slack as reference. I talked about this a couple times in the last few sessions, but where did that go? Hold on. I'm doing it again. All right. Well, I thought I had it in there, but one more place. Well, I'm talking about the thing about having perspective with 2 seconds and 2 minutes and all that. Anyway, I thought I had it in this channel, but really do that. There's certain things that are going to be useful right now for the next 2 seconds, and it's perspective. So really try to do that. And Amy's saying exactly the right thing. Put a reminder on something and say, I want to go back and look at this in 2 or 3 months. And that your brain will be totally different, because you'll have a lot more experience to judge it by. Okay, any other questions or comments? Cool. Hey, you know what? When the brain is ready, the material will appear, Amy, right? Okay, guys, have a great weekend. Excellent presentation once again, Lee. Thank you very much.
Pleasure, Jeff.
And we'll see all of you Monday for the Ides of Monday at 5:30 Pacific.
Great stuff. Thanks, everybody. Enjoy the rest of your weekend.
Okay.